France has just sold 129 tons of gold, and the global gold market is about to feel the impact. Yes, you heard correctly. The Banque de France has offloaded 129 metric tons of gold in one of the most calculated moves by any central bank in recent years. In its latest financial report, France revealed that it has completely sold the final portion of its gold reserves that was still stored overseas at the Federal Reserve Bank of New York. After this operation, France's entire official gold holdings, 2,437 tons, are now physically stored in Paris, inside the Banque de France's own secure vaults. But this is not a story about a country selling gold because it was desperate for cash. France sold these 129 tons through 26 separate transactions between July 2025 and January 2026. They sold the older, non-standard gold bars sitting in New York at record-high gold prices. Then, they used every single dollar from the sale to buy back an identical amount of modern, high-standard gold bars in Europe. The outcome? France pocketed a massive 12.8 billion euro capital gain, approximately 15 billion US dollars, while keeping their total gold reserves exactly the same. This was the final chapter of France's full gold repatriation strategy. The old bars no longer met current international standards, so instead of spending huge amounts on shipping and refining, France turned a logistical challenge into an extremely profitable upgrade, a masterclass in smart central banking. Now the big question on everyone's mind is simple. Why did France really make this move? Was it purely technical? Or does this signal something much larger for the future of gold? In Part 2, we'll dive deep into the real reasons behind this 129-ton gold sale, how they generated such an enormous profit, and what this tells us about how central banks are thinking in today's volatile world. This story is bigger than most investors realize, and it could change how you view the gold market forever. France has just sold 129 tons of gold, but the real question is, why? Many people immediately assumed France was selling because it needed cash or because of some political pressure. The truth is far more calculated and far more impressive. The Banque de France did not reduce its gold reserves by even 1 gram. Instead, this 129-ton sale was the final and smartest step in a long-planned strategy called full gold repatriation. For decades, a significant part of France's gold was stored at the Federal Reserve Bank of New York. While many countries are bringing their gold home, France took a highly practical and profitable approach with these last 129 tons. These bars were older, non-standard gold bars. They did not fully meet today's strict international good delivery standards for weight, shape, and purity that the global gold market now demands. Transporting them back to France, refining them, and recasting them would have been extremely expensive and logistically complicated. So France chose a brilliant alternative. Between July 2025 and January 2026, through 26 carefully executed transactions, the Banque de France sold these old bars directly in the United States, right where they were already stored, at some of the highest gold prices in history. Then, with the money received, they immediately purchased an exactly equal amount of modern, high-purity gold bars on the European market. These new bars meet all current standards and are much easier to store, trade, and use as collateral if ever needed. The financial result was spectacular. By selling at peak prices and buying back at market rates in Europe, the Banque de France recorded a capital gain of 12.8 billion euros, roughly 15 billion US dollars. This profit appeared directly in their 2025-2026 financial statements and significantly boosted the central bank's balance sheet. This move was not driven by politics or panic. It was a pure operational upgrade, turning outdated gold into cash at the best possible moment and immediately converting it into better quality gold, all while keeping France's total reserves unchanged at 2,437 tons. It also completed France's full repatriation. For the first time in modern history, every ounce of French official gold now sits securely in Paris, under direct French control. This decision shows a very sophisticated understanding of the gold market. The Banque de France waited for gold prices to rise sharply, avoided unnecessary costs, generated a huge one-time profit, and strengthened the quality and security of their reserves at the same time. So what does this mean for the wider gold market? In Part 3, we'll break down exactly how this sale was executed, the 26 transactions, the technical details of the old bars versus the new ones, and how the market actually absorbed this supply without major disruption. The mechanics behind this 129-ton operation are just as impressive as the profit it created. Stay with me. The technical side reveals even more about how smart central banks are operating today. France has just sold 129 tons of gold. But how exactly did they pull off this massive operation without crashing the market? Let's break it down step by step. The sale took place over a period of 6 months, from July 2025 to January 2026. During this time, the Banque de France executed 26 separate transactions. That's roughly one transaction every week on average. A deliberate, controlled approach rather than dumping everything at once. All 129 tons were older gold bars that had been stored for years at the Federal Reserve Bank of New York. These bars were cast decades ago and no longer fully complied with the modern, good delivery standards required by today's global gold market. Their weight, shape, and sometimes purity markings made them less attractive for large institutional buyers and more difficult to use in the international settlement system. Instead of incurring huge costs to ship thousands of bars across the Atlantic, refine them in Europe, and then recast them into new bars, France chose a much smarter path. Here's exactly what happened. First, the Banque de France sold the old bars directly in the United States, right where they were already sitting. Because the gold was physically in New York, the sale was quick, cheap, and settled almost instantly. They sold at prevailing market prices during a period when gold was trading near record highs. Second, with the cash received from each sale, they immediately bought an identical quantity of brand-new, high-standard gold bars on the European market. These new bars meet the strictest LBMA good delivery specifications: uniform weight, precise purity of 99.5% or higher, and modern serial numbering. They are easier to store, easier to verify, and more liquid if France ever needs to use them. This was essentially a sophisticated gold swap, selling non-standard bars in one location and replacing them with standard bars in another, without ever reducing France's total gold holdings. The entire operation was handled discreetly through major bullion banks and authorized counterparties. By spreading 129 tons across 26 transactions, France avoided flooding the market and minimized any negative price impact. The result was remarkable on multiple levels. They generated a €12.8 billion capital gain. They upgraded the quality of their entire gold stockpile. They completed the full repatriation of France's gold to Paris. They avoided millions of euros in transportation, insurance, and refining costs. This technical execution shows the high level of sophistication central banks apply when managing their gold reserves. It wasn't emotional or political, it was pure financial engineering at its best. France has now set a new benchmark for how large gold holders can modernize their reserves efficiently while locking in huge profits during bull markets. In Part 4, we move from the how to the so what. The immediate impact this 129-ton sale had on the global gold market. Did prices drop? Did traders panic? How did the market actually react when this supply hit the system? We'll analyze the price action, trading volumes, and market sentiment right after the news broke. The market reaction may surprise you. Stay with me for Part 4. France has just sold 129 tons of gold. Now the crucial question. What actually happened to the gold market when this news hit? And the Banque de France revealed the sale in its financial results in late March 2026. The immediate reaction in the gold market was a sharp sell-off. Gold prices dropped roughly 2.8% to 3.2% within the first 48 hours after the announcement. On the COMEX and London OTC markets, we saw a noticeable spike in trading volume as traders rushed to reassess positions. Why did the market react this way? 129 tons is a significant amount of physical gold supply entering the market in a relatively short period. Even though the sale was spread over 6 months and executed quietly, the public disclosure created a perception of increased central bank selling pressure. Many retail and institutional investors interpreted it as a signal that even a major gold-holding country like France was willing to offload gold at high prices. However, the real story is more nuanced. This was not new supply being dumped on the market in a disorderly way. France sold the old bars in the US and simultaneously bought an equal amount of new bars in Europe. In net terms, there was zero additional physical gold added to the global market. It was essentially an internal upgrade and relocation of existing reserves. Still, the optics mattered. The headline, "France sells 129 tons of gold," triggered algorithmic trading, stop-loss orders, and short-term profit-taking. The price dip was amplified by leveraged traders who were already positioned for volatility. On the positive side, the market absorbed the news relatively quickly. Within 1 week, gold prices recovered most of the initial losses and stabilized. This quick rebound showed strong underlying demand from other central banks, Asian buyers, and long-term investors who viewed the dip as a buying opportunity rather than a bearish signal. Interestingly, The sale also highlighted the depth and liquidity of the modern gold market. Even a 129-ton transaction, worth several $billion, did not cause a prolonged collapse in prices. This demonstrates how resilient the gold market has become, especially during periods of geopolitical tension and high inflation fears. Another important observation. While France was selling old bars in New York, many other central banks continued their aggressive gold buying spree in 2025 and 2026. Countries like China, India, Turkey, and several Middle Eastern nations kept adding to their reserves, which helped cushion the impact of France's sale. So the immediate market impact can be summarized as short-term price pressure and increased volatility, quick recovery due to strong physical demand elsewhere, no lasting negative effect on the overall bull market trend in gold. This event proved once again that central bank actions can create short-term noise, but they rarely change the bigger structural drivers of the gold price. In Part 5, the final part of this video, we look ahead. What does France's 129-ton gold sale mean for the long-term future of the gold market? How should investors position themselves? Will other central banks follow a similar strategy? And what price implications can we expect in the coming years? The long-term analysis may surprise many gold investors. Stay tuned for the conclusion in Part 5. Here's Part 5, the final part, ready to copy-paste into HeyGen. Part 5 title: Long-Term Analysis, What This Means for Gold Investors. Suggested video style for HeyGen. Professional serious avatar, consistent tone with previous parts. Background: dark, elegant gold theme with forward-looking graphics. On-screen text. Future outlook bullets, price forecast icons, investor tips. B-roll: rising gold price charts, central bank gold vaults worldwide. Investor portfolio visuals, global map with gold flow arrows. Full narration script. France has just sold 129 tons of gold. But what does this mean for the long-term future of the gold market, and for you as an investor? First, let's be very clear. This sale is not a bearish signal for gold. France did not reduce its total gold reserves. It simply upgraded older bars into modern ones, while locking in a massive €12.8 billion profit. In fact, this move actually strengthens the credibility of central bank gold holdings, because it shows they can manage their reserves intelligently and profitably. The bigger picture remains extremely bullish for gold. We are living in an era of accelerated de-dollarization. Many central banks, especially in Asia and the Middle East, continue to buy gold aggressively to diversify away from the US dollar. France's action does not change this structural trend. If anything, it proves that even Western central banks still treat gold as a core strategic asset worth holding and optimizing. What investors should watch closely: central bank behavior. Other major gold-holding countries may now study France's model. Expect more quiet upgrades, where central banks sell non-standard or overseas gold at high prices and replace it with better quality bars closer to home. This could create occasional short-term supply spikes, but the net effect on total global official reserves remains neutral or even positive. Market resilience. The gold market successfully absorbed 129 tons without any lasting damage. This demonstrates deep liquidity and strong underlying demand. Future large central bank transactions are less likely to cause panic if executed in a controlled manner like France did. Price implications. In the medium to long term, next 2 to 5 years, the structural drivers for higher gold prices remain intact. Persistent inflation concerns, geopolitical risks, high government debt levels, and continued central bank buying from emerging markets. France's profitable sale at peak prices actually reinforces the idea that smart money is still comfortable holding and trading gold at elevated levels. For individual investors, here are clear takeaways from this event. Treat short-term dips caused by central bank headlines as potential buying opportunities rather than reasons to sell. Focus on physical gold, quality gold ETFs, or mining stocks with strong balance sheets. Diversify a portion of your portfolio into gold as a hedge against currency debasement and geopolitical uncertainty, exactly what central banks themselves are doing. Keep an eye on repatriation trends. Countries bringing gold home or upgrading reserves signal confidence in gold's role as ultimate money. France's 129-ton operation is ultimately a masterclass in sophisticated reserve management. It shows that in a world of uncertainty, gold remains king, and the smartest players know how to maximize its value without letting go of it. This event does not mark the end of the gold bull market. On the contrary, it confirms that gold continues to play a vital strategic role in the global financial system. Thank you for watching this 5-part analysis on France's 129-ton gold sale and its impact on the gold markets. If you found this helpful, make sure to like, comment, and subscribe for more in-depth market breakdowns. Drop your thoughts in the comments. Do you think other central banks will follow France's strategy? Until next time, stay informed, stay diversified, and remember, in uncertain times, gold has always been the ultimate insurance. If you enjoyed this video, hit the like button, subscribe for more in-depth gold and finance breakdowns, and comment below. Will other central banks follow France's playbook? Stay informed, stay prepared, and remember, in times of uncertainty, gold has always been king. See you in the next video.